Hey everyone, how you doing today? This is the interview. This is the one that I mentioned in the daily financial news this morning. Super secret, Investor Mania 2.0. This is going to be a conversation you're going to want to listen to a couple of times. So let's welcome Rick Policio to the show. How you doing, buddy?
Hey, Michael, how are you? Thanks for having me. It's been since December since we last spoke.
Yeah, we had our first conversation in December. We talked about single family homes. We were talking about core logic and where you were and where I was on appreciation. And I went back. I was right. I was kind of the top of the three, right? I was here, you were here, and then core logic was like really stupid at like 6% or something.
Was
Uh,
that you forecasting full year 2020?
yeah, yeah, I was at
Yeah,
12%. So I was light. It came in at like 14.6 or something.
I know. It's funny. I was just answering some client emails before I jumped on this, asking about our home price appreciation forecast because we're still pretty bullish. I think more bullish than most people.
Mhm.
So glad to see there's another bull out there on home prices.
Absolutely, absolutely. Well, hey, what I want to talk about this conversation is a report that you put out under the perfect title, Investor Mania 2.0. I thought that was like nailed the sentiment. It talked about it, and there's so many different sections. But why don't you just talk about the report, how it came together, and then I really want to break it down because there's a lot in it.
Yeah, no, I appreciate you printing out the paper. It was about 45 pages or so, I think. And the so this the subtitle of the paper, so it's Investor Mania 2.0. I've got it up on my screen over here, so I'm just going to read the subtitle: How Data, Technology, and Yield Chasing Are Revolutionizing Housing While Raising Risk Levels. So that's
Mhm.
that's definitely a mouthful, but it's interesting because we actually had this paper teed up, ready to go for the most part, all the way back to March of 2020.
Yeah.
And I mean, we were about to hit send on it.
Yeah.
And so then obviously the world changed, and we said, okay, there's bigger fish to fry here. We're gonna have
Right.
to focus on some other things. But the the gist really of the paper even back then was, we're seeing a flood of investors come into the market. Stack that on top of the fundamentals are teed up for the strongest housing recovery we've seen really in many, many years.
Mhm.
And it had the foundation for us to revise our forecasts higher across the board.
Mhm.
And so that's what we planned on saying back in March of 2020, paused it.
Right.
And obviously other things going on, and fast forward to, I think it was towards the end of March 2021, so a few weeks ago,
Yep.
where we finally released it. And I think what we learned during that year where we were kind of tinkering with it was, holy mackerel, there's even more
Yeah.
investors and more capital flooding into housing than we even thought a year ago. And I'm sure during the Q&A, we'll talk about some of the investor categories too, and
Yeah.
why we called it 2.0 versus 1.0.
Absolutely. Well, the first thing I want to highlight is I've been trying to communicate on my channel via just consistent repetition that I believe that the single family asset is going to be one of the best performing assets, for the next decade, certainly the next 5 years, but perhaps the next decade. And it is because the asset class is kind of being institutionalized, right?
Yeah.
And we got the first taste of this in what I'll call Investor Mania 1.0, which is, okay, there's a crash. Warren Buffett has that favorite quote: "I'd buy every house I could if I could find scale," and all of
Yeah.
those things. Then you have American Homes and all these other for rent organizations spin up, and they're like, "Damn it, we can do this," right? That was kind of the genesis to prove
Right.
the model. But you fast forward, and really what's happened for me, and your report calls it out right in the first 4 or 5 pages. It's like, think about all the infrastructure that's been added around this. There's now a whole hard money engine for flippers. There's a whole build for rent idea. I mean, there's just all of these things coming around the single family home asset that is making it a play, as you call it, yield chasing. I call it deep pockets,
Yep.
because it's, if you can get 4% cap in an apartment building, but you can get 6.5 or 7 in a single family home. Do you really care if it's a house or an apartment? I mean, it's just the best place to play right now, I think.
Yeah, and I think, I'm rewinding back to our conversation in December. We talked a lot about the optimism around single
We
family
did.
rental, and we're still just crazy bullish on single family rental, and really the sustainability long term of the asset class. It means mom and pop investors have figured this out
Exactly.
forever, and now, to your point, institutions are figuring out too. And I think there was a big kind of pivot during COVID where you had a lot of investors, and when I say investor, I'm thinking more institutional,
Mhm.
that they've got mandates to invest in US real estate.
Yep.
And during COVID, leisure hospitality, nope, don't touch that. Apartments for the most part, namely in gateway cities, nope, don't touch that. Retail, don't touch that. And so,
Office, nope, don't touch
yeah,
that.
yeah, exactly. And so we had all of these groups coming to us and saying, "Hey, you guys cover this space. Can you help us?" And so we've added just a ton of clients over the last year or so.
For
And
sure.
and what's happened is you have these groups that they've historically invested in apartments, and that was kind of the way that institutions invested in US real estate.
Mhm.
And single family rental, the proof of concept, as you know, clearly established over the last decade. But I think what was interesting is that the bridge for a lot of these investors to getting them to be comfortable investing in single family rental was build for rent. So these are the purpose built, fully contained rental communities that in a way resemble apartments. It's easier to get their arms around,
Mhm.
namely from just a cost standpoint. So it looks more like apartments. And I think a lot of investors were scared away from SFR because it's more scattered site. How are we going to manage 50 homes here, 1,000 homes here? And so build for rent, I think, bridged that gap for a lot of investors.
Yeah, I think build for rent. I mean, I don't know what the numbers are. Maybe you have them, but when I looked at kind of the single family market, right, build for rent was right around 1 or 2%. What I could see happen very quickly, because I think it's proof of concept phase right now. It's now being proven, right? I believe you were the source for an article that talked about Texas. I forget exactly. I think it was 137 homes. If they sold it one off, they made 20%. They ended up packaging up as a build for rent, selling it occupied, and they made like 50%. Right? It's just
Was this the DR Horton
yeah,
transaction? I think
exactly. The DR Horton transaction. Exactly. And it's
yes.
like, well, let me think. They can control costs because they get away from variability. They build them faster because there's no options. And then they sell them for more. Huh. Should
A
I
good
do some
recipe.
more of that? I'm like, what?
Well, and what's really, I think, fueling a lot of this too is that the capital is thinking about it from a much more longer term
Exactly.
perspective. So home builders in the past have only had kind of one outlet.
Mhm.
It's the consumer, and then you've got kind of rental investors here and there. But now you've got this institutional pool. A lot of them looking at it from a purpose built for rent. We want the whole community.
Yep.
And oh, by the way, we're thinking about this in 10, 20, 30, 40-year increments, not a 1, 2, 3 year play. And so
Exactly.
that just opens up conversations that I think the sector has never really had before. Um,
Yeah.
go ahead. I think
Yeah,
you.
no, I was going to say, one of the outcomes of all of this is, again, I think the single family market is going through an evolutional change. It will be different in 5 years. And one of the differences is that a portion of the builders' capacity today will no longer go for consumers. They will still be building as many homes, probably more, but a percentage, we can argue if it's 10 or 20 or 50, 30, whatever it's going to be, will only go, I'll call it Wall Street or hedge funds, whatever you want, deep pockets, because they make more money, frankly. And
And, and so that's already being articulated with the public companies.
yeah,
So you've got you've got the large publicly traded single family rental groups saying we buy 10 to 15% of our homes from home builders.
wow.
And so that is happening for sure across the country, and it's not going away. And a lot of it too is that you've got, to your point, these deep pockets, and they've raised billions and billions of dollars, and
Billions,
and
just
and
dry
now
powder sitting there. What are we going to do with it all?
Exactly. I mean, we just put out a newsletter piece on our website, and these are just kind of free newsletters we do, looking at the deal flow in single family rental and build for rent over the last year and a half, and it's like 9 billion plus, and that's just the stuff that's been publicly put out there, and
Yeah.
that's not factoring in leverage, and they're all
Oh,
leveraging this.
Jesus Christ. Yeah.
So yeah, there's a mountain of capital that's
Yeah.
going to continue to grow in that business.
Yeah. So before we get into this, I failed at the beginning. How can people follow you? Because again, you put out a lot of stuff, and again, I've been following you on Twitter and John Burns as well. But let's give that a real quick plug. We'll do it again at the end. How should people follow you?
Yeah, so if you wanna follow, and to your point, I try to put out some stuff on Twitter, which it's obviously free, nuggets here and there. So
Mhm.
you can just follow me. I think my Twitter handle is in there. It's just at Rick Palacios Jr.
Mhm.
And then our website, you can just go to our company's website, realestateconsulting.com.
Mhm.
And obviously we've got paying clients, but we put out free newsletters, so you can just subscribe to those. And I've said it many, many times. I mean, I think some of our best stuff is out there. Like the infographic we put out today is amazing, showing the deal flow in SFR and build for rent.
Yeah. It's again, I follow you every day. It's something I look at in the evenings because I get ready to talk about the daily financial news the next day. So I'm always checking to see what you're putting out, going, what can I steal? What can I,
That's
what kind of information can I use?
that's the whole point. Yeah.
Awesome. Awesome.
Yeah.
Well, let's get back to the single family market because again, I've been this whole one rental at a time. I'm telling folks get in now. So we already know a portion of the market's going to the big guys, the deep pockets. They're going to be 9 billion leverage. And oh, by the way, if they're telling us they got 9 billion, it means they got 18 billion because they're not telling this they got it all. So that's going to be that market. That's going to be a lot of new construction, right? So if we flip the script to where I play, right? I still look for deals every day. Students follow every day. There's still a place for us to play, and the infrastructure around us is growing. Why don't you just talk about the stuff that's grown up over the last couple of years, all these hard money vendors and ways to
Yeah.
disposition and all that stuff.
Yep. So no, and I think this kind of brings it back to the paper
Mhm.
and the groups that we analyzed. And so kind of taking a step back. So Investor Mania 1.0 is what happened in '05, '06, '07, where the bulk of those investors were, I mean, they were individual retail buyers that were getting loans that they should have never gotten. The bank should have never underwritten those loans. And the acronym, you probably remember this, Michael, was the ninja loans, where it's
Yes.
no income, no jobs, no assets,
Yep.
and people were getting 5, 6 homes. So that's Investor Mania 1.0.
Agreed.
Knock on wood, we're not seeing that.
Mm-mm. Very
I,
different.
I'm always on the hunt for stuff like that and asking people, are you seeing it? Because that's definitely a cautionary flag. So that's Investor Mania 1.0.
Mhm.
And then the 2.0, to your point, is much more of this kind of institutionally backed umbrella of groups. And
Mhm.
so the groups that we categorized in the paper. So when we say investors, these are the subcategories. So it's flippers, which to your point have historically been hard money lenders. Now a lot of those are institutional lenders, and oh, by the way, the loans are being securitized to Wall Street. So
Yeah,
that's some
cheap money. I
old.
can tell you, investor 1.0 versus 2.0, the money's about half as much. It's pretty cheap money today.
Exactly. So you got flippers, you've got iBuyers all across the country now. A lot of
Yeah.
those groups are starting to go public, and those groups, in order to make that business work, you got to chase scale in the markets you're in.
Volume.
So
Yeah.
flippers, we got iBuyers. We talked about the single family rental landlords, and all of those are now becoming institutionally backed. Build for rent groups, I would put in there too. Vacation, second home, foreign buyers. And then the last category is probably the category that gives me the most concern,
Hmm.
because so there's this theme of democratization of rental investing, actually democratization of investing across all asset classes. I mean, you think about Robinhood, right?
Agreed.
So there's now platforms in the single family rental space that is what they are pitching. So it's fractional ownership. You don't have to own the whole home. You can own fractions of it. There's crowdfunding platforms. I mean, I feel like there's a new one popping up every week here. And so that's where we start to scratch our head because, the idea is that the people investing here, they should be accredited investors, but the reality is the thresholds have been watered down over the past probably 5 or 6 years. And so that's where we start to get concerned because actually, I mean, a lot of these groups are moving the needle and investing billions of dollars across US housing, namely in the rental market. So that's the 2.0 that we're thinking about from an investor standpoint.
Yeah, I gotta tell you that is everything else in Investor 2.0 makes me feel like, okay, it's good lending, it's real lending. We don't have the liar loans or ninja loans. We also don't have destructive and just horrible arms going out today. Most people get 30-year fixed.
Yes.
You
Remember negative amortization.
Neg ams. Oh,
Who thought of that and was like, this is a fantastic idea because home prices will never go down.
Of course, they never go down. Just refi. Oh, yeah. Yeah. But I got to tell you that fractional ownership, when I read about that, so I hadn't heard about it. Didn't cross my radar. So I'm glad you're in the know, right? This is your business and you're the best at it. But yeah, dude, that's a step too far. Anytime you get into an investment where you think it's easy and you don't really have to have the reserves. And then, oh, by the way, you're one of 10 people that own some house in some city and the roof gets blown off and they got the money and you don't. And man, it's just
that's
nightmare.
Yeah. And that was kind of our thinking is like, okay, this sounds great. Sounds very altruistic, but, at the end of the day, if you want to get out, how do you get out? Like to your point. So that is a category. And the way that I like, whenever I talk to people, especially people that are coming into the industry and some of our newer team members, I always advise them study cycles.
Yes.
And not just housing cycles, study asset cycles internationally going back, hundreds of years. And there's so many books out there that do this because there's a phrase that we use in the paper where it's history doesn't repeat, but it rhymes.
Yeah. A couple times.
You can look back over the course of 200-300 years and it's a different asset class, a different bubble, but the narratives that you start to hear, we said home prices never go down. That's one of them that's happened in the past. Different ways of speculating in the asset class. And so that's where you basically accelerate the liquidity in something that was historically illiquid. And that's kind of happening in housing. And then the thing that I always think about too is the marketability and what is being said in the media about an asset class. And
Absolutely.
so like in the paper, we talked about how and you participated in the last cycle. You've been through multiple cycles. So like think back to 04, 05, 06, and it was, newspapers you had CNBC, and then you had conversations that you had with your friends and colleagues and whatnot, and everybody was talking about housing. So now fast forward to today, you've got Twitter, which we already talked about. You've got the news outlets, obviously. You've got social media on steroids. You've got TikTok.
Steroids, yes.
And everything, YouTube channels, which, we're on a YouTube channel right now, but, you kind of start to stack up all of those participants and a lot of them are talking about housing right now, which gives us a little bit of concern too. And that's where we talked about how, housing's fantastic right now. We're super bullish over the next few years, but, our view is we're probably getting into these early bubble years. And you just need to have your antennas up and watch for things that could alter your thesis. And rates is first and foremost.
Oh, no question. Yeah, for me, again, it's in my book, right? I talk about affordability. I watch affordability in my market every month, right? It's kind of a monthly number. It's not necessarily daily. But yeah, when affordability in my market, California is, 0 to 100. When it gets down to 20, yellow, red flags, right? And it got down to as low as I think 16 or 17 in the last cycle. And just for scale, San Francisco is in 8, right? So there are markets that go much lower that don't make sense. But I guess there's two more things I know I want to talk about. First and foremost, we talk about housing. and we need to focus in a little more because housing is a big story, right? We need to realize that cash flow rentals, one rental at a time, affordability, all matters. So we are talking about the cheaper stuff, right? You talk about cash buyers dominating sub 100K, I think in the article. And I just got to tell you folks, I mean, in most markets, it's either 100 if you're kind of in the Midwest, or in your other areas, maybe it's 200. But that portion of the market, they're not building more housing stock for. So it's out there. And as you show in your paper, that portion of the market is very competitive and appreciating the fastest.
Yeah, I mean, good luck finding sub 100K in
Yeah.
California.
No.
I mean, I don't know if that exists, and you probably wouldn't want to own it. You might have to tear it down.
Yeah. If you cut the
And
dirt. Yeah.
there is some of it out in more affordable markets like the Midwest.
Mhm.
To your point, but the reality is, I mean, if you look at where most of the larger groups are buying or building new properties to rent out, it's generally in that 200 to maybe 325
Yeah, exactly.
price point. Yeah, and that's the meat of the housing market too. Like, right? Because if you
Mhm.
think nationally, median home price is like 275 and change. I know it's going up right now because
Yeah,
there's noise in the monthly print,
sure.
but that's a big part of why, I mean, we think you could be in a situation where housing, I don't want to say is permanently less affordable, but right now, those groups that we talk about in the paper are competing with the average buyer, with the mom and pop investor that's
Mhm.
trying to, add another home to their portfolio.
Yeah.
And the months of supply statistics that we look at across the country,
Scary.
there's some markets where you've got like 0.5 months of supply, but
Yeah.
that's overall.
Yeah.
Now go down to the price tiers that we're talking about. I mean, it's basically nothing.
Yeah. We no longer talk months or weeks. We talk days. It's just what you have to talk. It's crazy.
Yeah, it is nuts. I mean, I went through the last cycle, kind of the ups and downs,
Mhm.
and the tone that we're hearing now, the extreme optimism, the
Mm.
just no supply out there. I think what we're hanging our hat on, and we were talking about this earlier, is that we're still not seeing crazy mortgage lending. But
Yeah.
what, you've been through a cycle or two, and what generally happens is, the longer the cycle goes, the pool of buyers starts to shrink. And
Yeah.
so what do lenders do? They start to expand that credit box
Yep.
to continue to try to feed that machine. And
Mhm.
so that is the thing that I'm watching the closest here, because if rates start to come up, are we going to see ARMs come back into the picture? Are we going to
Oh my
start to
God.
see these creative products that consumers who didn't live through it last time,
Mhm.
they see it and, oh, this is a fantastic idea. This sounds great. I lower my payment. And you're like, wait, no, here's what could happen.
Right. Let me tell you a story. It doesn't end well.
Yeah.
It's a nightmare. Yeah. Well, the other thing I wanted to talk about today is a lot of housing today is we've talked about the demand side. We have to talk about the supply side, because what I call it today is we have the perfect storm of limited supply. So this is what I'm thinking. And again, you're in the business as much as I am, and I only look at one market, you look at the nation. So first and foremost, we go back to, March, April of last year, right? We basically tell existing homeowners, stay home. Don't let anybody come touch your stuff. And oh, by the way, don't go touch other people's stuff, right? That's basically what we told them.
Yeah.
So first thing, if you were thinking about selling that spring season, because we were right on the cusp of the spring selling season, you're like, nope, I might list in the summer. Let's see where this thing goes. And then, oh, by the way, bad stuff happens. The job market gets squirrely. People are like, not sure if I'm going to have a job, or my husband or my wife. We're not doing anything.
Pause
Oh
it.
yeah,
Yeah.
we'll paint the bedroom, right? We'll go to Lowe's and Home Depot and, home improvement aisle city. So that happened, right? Next, builders, right? Builders were doing, they were doing their thing. Again, this happens. Stop. Nobody can come see your stuff. They start listing on the MLS. people start canceling contracts. Oh, by the way, fast forward, now you have inflation and everything from lumber to appliances and windows. And, so they basically are now they're canceling contracts because of, prices. So
Yep.
again, new construction as low as possible. Also, let's not forget that life events happens. And, every year we have foreclosures, except this year, right? Because everybody gets a foreclosure moratorium. And even if you get divorced or you lose your job and you got to live somewhere else, why foreclose? Nobody's going to So we basically have the perfect storm for no inventory, right? My thinking is that starts to reverse June-ish, right? And CDC thing gets out of the way. The summer, more and more people are vaccinated. Like, I can start touching other people's stuff. I got all this equity in my house. It's too old. It's too small. I want to go somewhere else. So I could see a lot of inventory coming this summer. Am I crazy?
I don't think you're crazy. I don't know if I would say a lot.
Well,
Let's
give you this. Let's give you a number, because you look at it, right? We have, roughly speaking, 1 million homes available today.
Yep.
Roughly,
and then
right?
I think so. If memory serves me, like I'm thinking about all the loans that are in forbearance right now.
3.2.
Right. So like, I think we ran this the other day. Gosh, now it's pissing me off. I can't remember it. But if you just stack that immediately on top of it, I think we would get back to a number that was still below what we saw during kind of the run up in supply, the last cycle.
We would.
That's not going to happen. It's not going to be an immediate spike. And then, like, to your point too, the equity position for most of these homeowners is like a 180 of what we saw during the subprime crisis. And they've all got chunks of cash in that house, given we've had, I mean, let's just rattle off some markets. Like, if you live in Phoenix, home prices have gone up 20% plus year over year. If you live in Boise, they're up 31% year over year. Like, you go around the country and most of these markets have had double-digit home price appreciation year after year. I mean, the last year has just been nuts and just insane. But if they want to sell their home, they should have, it's not going to be a distressed sale. So,
not going to happen.
Yeah. And like, as you were just going through all of those, hey, there's this, hey, there's this, oh, by the way, we're not going to allow foreclosures. And there's still some uncertainty if that's going to even be allowed in July. They may push that out to December.
Well, I think the foreclosures are extended to December. The CDC thing is evictions for landlords.
Okay.
Right. So again, no foreclosure. This is going to be, oh, this is so crazy. Last time the term was strategic default. Remember that?
Yeah.
This term is going to be avoidable foreclosures. There are going to be zero. They're going to put 40-year mortgages. I'm convinced people are going to be locked into their houses forever. It'll be like rent control. You're going to have people can't afford to move because they have all the, the back end second stick in there, and it's going to be bad. But the 3.2 is not going to come on the market this year. It'll be next year.
No. And I mean, we just walked through all these groups that have raised billions of dollars to grow their portfolio. So they're in a lot of ways, they're
going to governor. They're hoping for a 5% discount.
Exactly. Yeah. But as you were going through and just kind of like checking off all these boxes of this is different, this is different, this is different, no foreclosures. That's exactly what we were doing. And I had this conversation so many times with people last year because they said, well, gosh, you're so optimistic on home prices. And we still are for this year. I think this year we're forecasting 12% on
12
retail.
And then 6, according to the article.
And new home prices, this is net of incentives. There's basically no incentives for home builders right now. 15%. We just revised that up this month. And so like when I was having these conversations, I said, well, look, when the system changes and there's new rules, you have to change your model and the way you think about it. And I think you and I talked about this back in December, where there were other groups out there forecasting price declines.
We did.
And
we laughed. Were talking about, we're like, what?
Well, because their model relied so heavily on the unemployment rate.
So
and if that's what your model says, and it's going to spit out a really negative number, because historically, when you get a recession and employment spikes, housing doesn't do great.
Yep.
But this is a totally different backdrop, which is what you just said.
Exactly. Yeah. Yeah. But I want to put this out there. I want to get it recorded. So we have, let's just call it 1 million available homes today. I'm going to say we could be up to 2 million homes by August 1st. Now, put that in context. On the surface, that's 100% gain. Kind of cool, but still 60% of where we need to be for a balanced market. So
yeah, and on the home, I mean, because we're super close to the home building space. I mean, that's
Mhm.
really our bread and butter. Although single family rental has been huge for us lately. Um, Home builders just kind of shut off the machine a year
Yeah.
ago
Yeah, they did.
because that's what a smart home builder would do. If you thought the sky was falling,
Mm-hmm.
you have to basically say, okay, we need to figure this out right now.
Yeah.
And they shut off land buying for a while, and then they realized, just as most people in the industry, by probably middle to end of April last year, okay, this is actually going to be better than what we thought. Then they got to May, and it was, holy crap, this could be the strongest housing market we've ever seen,
Exactly.
and we're in the middle of a pandemic. And so when when you're a home builder, you don't buy land and build and sell homes on it the next day. I mean, this is a 6 month to now upwards of a year process
Mm-hmm.
to build those homes. And this is on like a finished lot. Like, I've got the lot. All right, let's build the home. I mean, if you're trying to entitle land in California, good luck. I mean, that's a multi-year process. So that's where I think we're on the same page, in that our home price forecasts are the strongest this year. I mean,
Yes.
we've got, unless something radically changes there on the economic front, on the interest rate front, we've got very high conviction that we're going to see probably the strongest home price appreciation we've seen since probably '05, I think it is.
Yeah. '05 was the best. Yeah.
But then we get to next year, and I do agree with you. You're going to see more resale inventory come onto the market, and because people are going to start looking around and saying, "Oh my gosh, Zillow told me this guy just sold his house for
Exactly.
how much?" Okay,
Consumers are the same. They're like,
let me
holy
take a shot at
cow.
that.
Yeah.
Yeah, and so that will happen.
Yeah.
Consumers will do that over time, and then home builders are just buying land hand over fist. They've been doing that probably the last 9+ months,
Interesting.
and their footprints, their community counts, and we track this stuff too. They're growing, but it's not going to start to really pop up materially until we think maybe the end of this year, and then
That makes
going
sense.
into 2022. So you think about new home supply, you think about resale supply gradually rising by 2022. And that's econ 101, is, okay, if there's more supply than we had a year ago, you're probably not going to get the crazy home price appreciation you had. But we're still forecasting growth. We've actually got home price appreciation growth in our forecast all the way out through 2024 right now.
Yeah, I'd agree with that. Yeah, 20. Yeah. Yeah, my crystal ball breaks at 2025, so I don't go out farther than that. But
Yeah, that's
that's a far way.
yeah,
That's a long way.
I hate having to go out that far, but we've got a lot of people that want to have a view on it, so we try.
Yeah. But if we go back to mom and pop investors, what I want them to hear in this conversation, Investor Mania 2.0 is actually good for them, in my opinion. There's a lot more infrastructure. There's a lot more ways to dispose of, get rid of, or add, but you do have to do some work. You have to know, really, for me, it's like, okay, where are the deep pockets playing? Because I'm not going to play there. They can outpay me every day, right? They have the
Yep.
cheapest money, permanent financing, longest time horizon. Okay, they want all the 3-bedroom, 2-bath, 4-bedroom, 2-bath, 3-year-old homes. Great. I'm not looking at those, for example. So I need to look in other places. And cash flow is still available. You just have to work hard for it. And I think what I was going with inventory is, I think inventory is going to come. I think quality difference is going to finally mean something. What hasn't meant anything when you have only 1 million homes is quality doesn't mean squat. Trashed house, perfect house, everything gets retail pricing.
Yeah,
But
it's
if
all
you
getting
double inventory, you still have the top-notch, prettiest, best location going quick, but you're going to see inventory differences, which finally means I can buy more than 6 houses in a year. I can do 10 or 12. But mom and pop investors, I think you need get in. If the rich are coming, and they're clearly coming, but they're not here yet, get in, because you could get the wind at your backs as they raise prices. Some is good, more is better, in my opinion.
Yeah, I mean, if you can get in
Mm.
and have your your risk gauges dialed in very close.
Yeah.
And the way we've got a ton of different risk metrics that we look at, and there are some markets where affordability looks horrible.
Yeah.
Uh,
Like, do
and
you
s-
know one off the top of your head?
well, I mean, if you look in Texas, and
Yeah.
so that we look at it from that market unique to itself.
Hmm.
What do historical affordability metrics look like?
Yeah. It's got to be
And
different.
so like if you've lived and breathed in Texas your whole life, those affordability metrics look close to the worst that we've ever seen.
Mhm. That would make
But
sense.
one of the kind of views that we have is that because of work from home, because of people
Exactly.
moving around the country right now, you're going to see affordability metrics get out of whack more than what I think you would think is kind of rational,
Mm.
because people are viewing their home differently, and I do think that's going to be a structural change for
Agreed.
housing, where
Agreed.
my employer now is telling me, and this is going to be permanent, come in maybe twice a week. Okay, I can go buy a house further out.
Mhm.
I'm going to pay more for it because I value this house differently now. I'm here more, I'm working more. And then you've got people, I mean, if you leave California and you go to Texas, Texas actually looks affordable. If you leave California and you go to Boise's crazy affordable.
Yeah,
And so
exactly.
so those are the unique things that are going on right now, because everybody, if you're coming from a different market, your affordability anchor
Mhm.
mentally is different from domestic person that's lived in that market their whole life.
Yeah, I think what you're going to see, and what I'm calling that, is destination bias. Right, you're going to, like, Texas would not have shocked me. It would have been my guess. It was either going to be Texas or Vegas. You were going to tell me, because it's just different this time, right? People, I mean, Austin, for example, is the market I think that's just most over the top unaffordable. But it's because you have Elon Musk saying, come here, and you have all these other tech execs going there, going, we're going to make the next
Yeah.
Silicon Valley, right? So you get all this imported home equity from California, the six-figure jobs, no state income tax. You're like, damn, this is cheap. But the people
It's
who live there are like, where the hell are these California plates from?
Yeah, and I would recommend, if you leave California, you can go out to Texas, you go out to Boise, change your plates as soon as you can,
Please, yeah.
because I've been talking to some clients in Austin, in Boise, and they have said that the locals are not huge fans of Californians right now. But we're talking about these markets. I had a post, actually it was yesterday, on Twitter, that I put out, because we do a mid-month channel check just of home builders across the
I
country.
saw that. Yeah.
And I kind of just went through, because I was reading
That
through
was
it,
awesome.
and I was like, holy crap, the color in here is just so one-sided, crazy positive. And I mean, builders are having a tough time adding supply, and the cost issues, but they are pushing price, and consumers aren't really pushing back. And so Austin was one of those, just the color was insane. Boise, I think it was insane. Vegas, Phoenix. And so that is kind of the tone right now in housing.
Yeah. The one market I don't know if you have an opinion on that just always feels unnatural to me is Vegas, right? You think about Vegas, I think service industries, right? It's casinos and
Yep.
all around it, right? Some manufacturing, light manufacturing, but not it's basically a service economy. And they have, I don't know if they still have, but the last unemployment number I saw was over 20%. But yet they have record housing prices. I talk to a broker there once a month, and he's like, no inventory. If you're above $1 million, you're a California buyer. You're below a
Yep.
million bucks, you're a local buyer. And just no inventory. And I'm like, this makes no sense to me. But do you have any
So
thoughts?
Vegas, I'm looking down at the paper because I know Vegas popped up.
Yeah.
Nobody
Up.
can see this, but so Vegas investor transactions, and this is as of the fourth quarter last year. We're just getting first quarter data, and we got to go through and audit it. Um, Investors accounted for 24% of transactions, new
Oh,
and resale, in
one in
Las
four.
Vegas. So that's definitely, and that's where our view is that investors are definitely accelerating this recovery.
Mm-hmm.
I'll tell you though, also, some of the color that we've picked up over the last year in talking to some of our single family rental clients, some of our home builder clients, there's a big influx of people that are working remote, and their employer is somewhere else
Mm-hmm.
besides Vegas,
Yep.
but they've gone and bought a home and are living in Vegas. It may be a second home, maybe a vacation home. So, but and then they're working remote into other parts of the country. So
Sure.
that's definitely happening. And I mean, I think there was an article in the Journal a couple of weeks ago on Vegas and how it's not Sin City
Hmm.
that it has been in the past. And there's great communities. There's
Hmm.
home builders that are adding new supply in that market,
Yeah.
and there's a lot of families that are moving out there.
Yeah. Yeah, I mean, I talked to a builder or a broker there that was there through the last crisis, and we talked a year ago, and we're like, Michael, if we're going to see a repeat of the last crisis, what will start is lot premiums, right? Lot premiums would have been the canary in the coal mine. So we're like,
Yes.
like for 6 months, I'm like, okay, our lot premium is down. Our lot premium is down. I was like, nope, they're going up. I'm like, damn, where are all people doing in Vegas, man? It's crazy.
Well, what's the lot premium in Vegas? Like, what are you? I'm trying to figure out like what are you looking at that justifies that that crazy lot premium. But that is so lot premiums are one. You're totally spot on. Lot premiums are one of the things that when you've got your kind of bubble radar on,
Yeah.
that is the low hanging fruit for profit margin for builders.
Oh yeah.
There's a view here. I mean, it's a subjective opinion, obviously. And they charge for it. And when the market's crazy hot, I mean, that is a low hanging fruit to just juice your returns as a home seller.
Yeah. Yeah. That's something I kept asking about, just expecting it to go away, and it never did. And it was just
No,
crazy. So
no.
if we're going to wrap this up, and again, one rental at a time, mom and pop, buying houses as rentals, I think it's the best asset. You have all this money coming in. They're going to be focused on a portion of the market. It's going to be hard, right? It's a competitive market. I do think more inventory is coming, so at least you'll have more choices. I think prices go up. I think rents go up. I think that's another thing that comes out of this is my experience. Prices go up first, rents go up second. Because as affordability drops, more people rent. Space is good in this crisis. You don't want to live close together. So I think the single family home as a landlord is going to be a great asset to own for the next 5 to 10 years. Any closing thoughts? And then again, where do you want people to follow you?
Yeah, no. So the other thing, as you were just saying, that I was thinking about is we hear this phrase thrown out recently, this kind of everything bubble.
Yeah.
And you've got crypto going insane and NFT and all of these things that, you know, totally new this
Mm-hmm.
cycle. And so you take a step back and you go, okay, where can I put my money where I understand the asset, it's tangible, it's usually an inflation hedge.
Mm-hmm.
Like historically, that's what housing is. And oh, by the way, I can live in it or I can rent it out and I can raise the rent if we do get in an inflationary environment. That's where I think a lot of people are looking at their options right now. And in an everything bubble, having rental properties, and if you can ride out that down cycle, not the worst place to be if you're just thinking about, okay, what actually makes sense if all of this kind of crypto craziness starts to go south.
Yeah.
And I wouldn't doubt that there's people that are hedging their bets and selling some crypto and pushing that into housing.
It wouldn't shock me. The last thing I'll talk about in residential space, folks, is go get that 30-year money. Please don't get an
Oh
arm.
yeah.
Don't get any of that stupid stuff. If they want to give you something with a 3 on it, that's basically free money. So
Yeah.
lock it into, again, rents will go up in the future. You will be a very, very happy person, but don't buy any alligators. No negative cash flow. Do the work, find a good deal. And again, Investor Mania 2.0 is going to help you get wealthy, in my opinion. Rick, where can people follow you?
Yeah, you can follow me on Twitter. It's just my name at Rick Palacios Jr. And then, like I mentioned earlier, you can go to our website, realestateconsulting.com. We've got great free newsletters there. And if anybody has questions, you can always message me, DM me. And I usually try, I'm kind of like you, Michael, where it's a night thing
Yeah.
where you just go in, you're like, okay, let me help. Let me answer some of these. So yeah, always happy to help there.
And he is, folks. He answers my questions all the time. So thank you very much, Rick. I appreciate you. I'll look forward to next time.
Yeah. Awesome. Thanks, Michael.
Got it.
See ya.